Good evening, afternoon, and good morning to all participants to this webinar, this ESG data webinar. The theme is From Regulation to Community View. Rajul and I know each other from the MiFID II regulation, and in that light we thought it's interesting to partner up again. So Synchron and SIX and Orenda decided to organize this webinar to give follow-up to the MiFID II and dive into the interesting world of ESG. Rajul.
Thank you, Jon. And before we go to the introduction of SIX, as Jon said, good evening, good afternoon, and good morning, depending on where from. Welcome to the webinar where we cover ESG both from a regulatory standpoint and at the other end of the spectrum, the community view. And I hope you are well informed and get some interesting key takeaways from the session. Handing it back to Jon for the introduction.
Thank you, Rajul. For people who don't know, I'll introduce SIX shortly. SIX is a group. We're European-based and privately owned. We have the SIX stock exchange and the Madrid stock exchange. We do security services. We have the division financial information, and we provide banking services to the Swiss financial industry. The division I work for is the financial information division. We're consolidating data. We're putting standardization, normalization, and validation on top of the data. We're focused strongly on reference, compliance, market, and tax data, as well as ESG data. So that together we consolidate and deliver to the market. We are around for around 90 years. We're the only European-based data provider that's out there. We are present in 20 countries, and we have over 5,000 sources where we source the data from. Rajul, up to you to give a short introduction into Synchron.
Thanks, Jon. So Synchron is the largest privately owned pure-play financial services provider. So our key unique proposition is that we leverage the power of business and technology to bring solutions and consulting services to our clients. Founded almost 20 years back, worldwide more than 10,000 people. We have a global footprint, and as I said, we only operate within the financial services industry. And I'm personally based out of Amsterdam. Moving on further to the agenda for today, we're going to start the content with Janine talking about the ESG regulatory data and what it means in terms of SFDR and taxonomy. Then we move on to Hashim Olala from Synchron, who will be talking about the ESG data landscape, including various data providers that are out there. Then I'll give a short demo of the ESG booster that Synchron has built over the course of last 12 months. And finally, we'll move or hand it over to the CEO of Orenda, Tarja, to talk about the community view and how it plays in the ESG realm. And finally, we'll conclude with the Q&A. With this, I'd like to hand over to Janine Hofer for the ESG regulatory data.
Are you getting ready for the EU ESG regulations? Do you see these regulations as a compliance exercise or as an opportunity for your institution? Hi, welcome to this webinar. My name is Janine Hofer-Witwer. At SIX Financial Information, I'm responsible for developing data services that enable sustainable finance, ESG, and impact investing. Today, I will talk about what the EU is working on when it comes to sustainable finance regulations, what this means for corporates and financial institutions, and how this relates to data. I will also talk about that this is more or can be more than a box-ticking exercise and can actually be turned into a competitive advantage. We see several macro trends in ESG investing. The first big one is increasing investor demand in ESG investment products. This was really led by institutional investors, but the trend is now also expected to be mirrored by retail investors, especially as a younger generation, millennials, is acquiring more and more wealth. Then the second big theme is the growth in ESG investment products, which of course is an answer to the increasing demand. According to an Optimus study, the value of assets under management at funds applying ESG criteria has increased from $22.9 trillion in 2016 to $40.5 trillion in 2020. And with that, we also see new issuance of sustainable investment funds on a regular basis. This is also mirrored on the SIX database, where we see big increases in such products. And then also on the bond side with green, social and sustainable bonds that are growing and increasing rapidly. And the third big trend is the political and the regulatory environment. It all started with the UN Sustainable Development Goals in 2015 and was then followed by the UN Paris Agreement in 2016. Nowadays, there are 189 countries that are signatories to the UN Paris Agreement. And there is also rising legislative and regulatory pressure, not only from the EU, but the EU is going ahead on this, but there are also many other countries that are now developing regulations to make this also a requirement and not only a nice to have. So the EU developed the EU Action Plan on Sustainable Finance. It's based on the Paris Agreement and on the UN 2030 Agenda for Sustainable Development. The EU Action Plan has three main goals. The first one is to reorient capital flows toward sustainable investment to enable sustainable and inclusive growth. The second goal is to manage financial risks that are stemming from climate change, other environmental or social issues, because every company and every financial institution nowadays is also affected by those issues, and they pose risks to an institution. And the third goal is to foster transparency and long-termism in financial and economic activity. And this is really where the data aspect and the transparency aspect comes in. Under the EU Action Plan, we found a total of 28 regulatory initiatives, and two of those, the taxonomy and the SFDR regulation, SFDR standing for Sustainable Finance Disclosure Regulations, those two we are having a closer look at today. So who is affected by the regulations? We have the challenge that under the SFDR regulation, it's only financial service providers that need to comply. So there is a challenge that from the investee company, which is the data that the financial service providers need in order to make their disclosures, there is no requirement to disclose ESG performance data. So there is a bit of a vacuum, at least at the moment. There is the proposed Corporate Sustainability Reporting Directive, but this was only proposed back in April. This will fill a gap if it comes, but this is not expected before 2023. Now, on the financial service provider side, both the taxonomy and the SFDR regulation apply to investment advisors, manufacturers of financial products, institutional investors, asset managers, and also the insurance and index sector. So a wide range of financial institutions. And it's not only financial institutions that are headquartered in the EU, but actually any financial institutions that has dealings in the EU, be it a client there or managing an EU-based product, for example. At SIX, we see ourselves as a data hub. So we source data from many different providers. We aggregate, normalize, and standardize the data, and then deliver it to our clients via our well-known delivery capabilities. So for SFDR, this means we're sourcing this investee company data from ESG specialist data providers, at least in a first step. There may be a central data repository later on, but for the time being, we source from different specialist data providers, and we provide that data to the manufacturers of financial products and also to the investment firms that make direct investments. We also map this corporate data to the equities and bonds that are issued by such companies for easier ingestion by our clients. Now, on the financial institution side, the right-hand side on the picture, the financial institutions will either comply or issue a statement that the adverse impacts of investment decision on sustainability factors are not considered and the reasons therefore. So there is a comply or explain principle. But I believe with the increased investor demand, there will be more and more financial institutions that will comply and that want to issue ESG-focused product to really address that client need. And for those products, we're sourcing detailed information on product level, but also on entity level. That means the asset manager as a whole. That data we're sourcing directly from all the asset managers, several hundred asset managers. And we also provide that information to the investment firms that are selling those products to their clients. So important to know there are two levels of data: the investee company data that we can provide, which is shown with the blue arrows in this picture, and also the product manufacturer data, which is shown with the red arrows in this picture. So why should you choose SIX for your ESG regulatory data needs? Of course, we support you in your disclosure requirements, and we have a proven track record in regulatory data, so we can build on that know-how and expertise. We deliver an aggregated and normalized data feed or file delivery, and that means on your end, you can get data from different sources, but that data is normalized, comparable, and machine readable. And we provide this also via our established delivery channels, which makes it the complexity of data sourcing much easier also because you can get all this data from one source. And this will free up internal resources and lets you tackle other priorities. And if you're an existing client of ours, of course, we can leverage our existing relationship, and it also means that you already are well aware of our data and know our data structures and our delivery capabilities, so you don't need to implement yet another feed. SFDR is also linked to other regulations. This is an example how it relates to MiFID II. Under MiFID II from October 2022, clients will be asked or will have to be asked for their ESG preferences. So that means if clients then say, oh yes, ESG is important to me, then those clients have to be sold or recommended investment products that fulfill their expectations. And for that reason, we introduced the sustainability preferences flag that's delivered with the EMT 3.1 version. And that indicates if a financial product or a fund is a so-called Article 8 product under SFDR, which is also a light green product or a product with ESG characteristics, or if it is an Article 9 product or a dark green fund, and that means this fund has sustainability or sustainable objectives. And then there is also an indication for neutral, which is the same as so-called Article 6 under SFDR. That means the assessment has been done, but that specific product is not qualified an ESG-focused product. And in the future, we expect all the funds flagged as such ESG or sustainable investments to make detailed SFDR disclosures. So in terms of timeline, the SFDR level 1 regulations are already in force. Level 2 regulation are expected to enter into force in January 2022. This is the entity principal adverse impact indicators and also the product level periodic disclosures. The principal adverse impact indicator are 64 data fields, so quite detailed disclosures on E, S and G factors. And this is the data set that will be provided in addition to some other data points for the SFDR data delivery. However, the product manufacturers will actually not make their disclosures from the 1st of January 2022, but start in 2023. So they will have to make their disclosures until the 30th of June 2023 for the calendar year 2022. And in terms of the 6th timeline, this means, as I mentioned, we already deliver the sustainability preferences flag currently under the MiFID II investor protection data set. And on the 12th of July, we're going to release the structures to be able to deliver the investee SFDR data, investee company SFDR data, as well as a bit later on the product manufacturer SFDR data with the detailed principal adverse impact indicators. On the taxonomy, the picture looks very similar as the logic of data sourcing and data provision is very similar to SFDR. The content is, of course, different. This is even a more extensive, a very extensive data set on the taxonomy as it requires reporting on alignment with 6 environmental objectives: climate change mitigation and adaptation in the first step, and then water, circular economy, pollution and biodiversity in the next step. So at 6, again, we source this company data or investee company data, provide this to manufacturers as well as investment firms who make their disclosures, and again, direct sourcing from the manufacturers of financial products on entity and fund level. And that data, again, can also be disclosed to investment firms who need to report if they're selling those financial products. Again, the logic of investee, company and manufacturer data. Timeline, there is a little bit more time. The application of the disclosure requirements for the 2 climate-related objectives is supposed to come from January 2022, followed by the application of the disclosure requirements for the other 4 environmental objectives 1 year later, 1st January 2023. This if it is not postponed. And as in terms of 6, we plan a first taxonomy release for November this year. So the main takeaways are these regulations will have a huge impact on financial institutions and corporates. At the moment, the availability of ESG data is a challenge, but through the regulations, we will see more and more ESG data on a detailed level being made available to the market. So with this, I really think these regulations are not only a challenge and a compliance exercise, but can really be used to position a financial institutions with innovative ESG investments and make it really attractive for their clients. And the increased availability of ESG data will support that strategy. Thanks for your attention. I now hand over to my colleague from Synechron, Hashem Olale.
Yeah, thank you, Janine. And thanks again, everybody, for joining today. My name is Hashim Olala, and I will be talking about the ESG data landscape and some of the challenges and opportunities that we're seeing in the space. So as a result of this increased interest in sustainability and ESG, we also see, of course, a very much increase in spending in the ESG data space. A recent recent study forecasted that by 2021 we would reach approximately $1 billion in US dollar spending this year, and roughly 60% of that is now coming from Europe, roughly 33% from out of the US, North America, and the remaining is coming from out of Asia, which showcased that there was a lot of movement happening in the ESG data landscape. So we can categorize how the landscape looks like. We can really bucket it down into 4 categories. Clearly, a lot of the data is coming from the companies themselves. So the self-reported data is a very important source, and often that's coming through whether it's websites, your annual reports, sustainability reports. By this year, I think more than 90% of all the S&P 500 companies are producing so-called sustainability reports. So there's a lot of interest and a lot of incentive from the market to produce this data themselves. Another valuable source for ESG is, of course, news data, social media data, but also satellite imagery. So there was a lot of data points that we can use for real-time ESG signals. And then thirdly, we also have reputational data. So a lot of institutions like NGOs and governments are tracking movements in the market and producing their own reports on what these companies are doing. And lastly, and that we'll cover today a bit more detail, is of course the third-party ratings that are using various of these underlying raw data sources to produce their own so-called ESG ratings. So if we look at the landscape as a whole, it becomes clear that there was a lot of ESG data increasingly available. As Janine already said, more and more data will become available, but it's a highly fragmented landscape, meaning that a lot of data comes in different formats, often unstructured, different languages. So it's very challenging for industry participants to use that data. And on top of that, there is still no ground truth, right? As regulation is still evolving, this makes a data interpretation a bit subjective and vulnerable for noise. And that's what I will be covering for the rest of my presentation. We'll be covering some of these data sources and discussing what are some of the challenges that we're seeing in using that data. So we'll first start off with the so-called self-reported ESG data. And there is a lot of, in the past, have been, reports, etc., studies looking into the risk of greenwashing. A report from a couple of years ago, for example, saw that from some of the reputable sustainability reports, from the known negative events, 90% of those events were not disclosed in the so-called sustainability reports. And when another study, for example, analyzed the language in these sustainability reports and found that 50% of the language was very generic of nature, meaning that it could be applied to any company or any industry. And on top of that, 20% of the language was company specific, but didn't include any tangible performance metrics or results. So as a result of that, it's clear that greenwashing is a very clear and risk out there, and it's something that market participants will have to take into consideration. On top of that, the data often is incomplete. It's not updated frequently, making it very difficult for investors to react quickly if a so-called ESG controversy happens after such a report has been published. So to wrap it up or to conclude, it's challenging to not only extract the data, analyze it, but also to benchmark it against any taxonomy or specifically the sustainable development goals. Hence, as a data source, there are clearly limitations to so-called self-reported ESG data. And if we look into the third-party ratings, there is, as I mentioned, there is a lot of new data providers coming out there, and we can typically categorize them in 3 buckets. So we have the so-called ESG specialist data providers, most prominently being Sustainalytics, but there's also a couple of other ones in the market. Then we have a lot of more traditional market data providers like Bloomberg or Refinitiv, who've been rapidly moving into this space and coming up with their own ESG ratings. And then we have the so-called analytics platforms, such as True Value Labs, that have a very specific approach towards using only news data to produce their ESG insights. Orenda is also a very interesting one, and that will be covered later in the presentation today, because they're only looking at social media data, and Tanya will cover their approach and methodology in that space. So if we look at this table, it already becomes very clear evident that there is big differences in terms of the rating scale and approach and coverage as such. And we'll go into that and go a little bit into that in detail more later. And that's also one of has resulted in a recent warning from the FCA, because based on their own study, they found that not just slightly more than 50% of these ratings were consistent. And that's very much in line with some of our own studies we've done within Synchron. And I think there is a very good report from or study done by MIT across 5 leading rating agencies, which showcased that there was only a 0.61 correlation in these rating across some of the 5 of the leading rating agencies. And as a comparison, if you look at the more reputational, 2 of the leading reputational credit rating agencies, that correlation is roughly 0.99. So it does showcase that we still have a very long way to go, and that although the rating providers are definitely helping companies in providing or extracting insights from the raw data, but there is clearly limitations to these data sets or these ratings. So what are these key challenges, and what are the differences? Well, I think if we look at, as I mentioned already, an important one is related to the underlying raw data, meaning there is clearly differences in terms of what kind of sources the companies, the rating agencies are using, whether it's only the raw data or self-reported data, whether they're using news data or alternative data. There is also a big difference in terms of the availability of the data, historical data. Sometimes there's differences even between companies on how much available historical data there is. And clearly, there is also some data quality issues. For example, a lot of these rating agencies go by the concept of disclosure, meaning that if a company would disclose any ESG activity around their so-called human rights policies in their sustainability reports, that could potentially lead to a positive performance compared to a company that wouldn't report on so-called initiatives. Then we also see big differences in terms of the methodology that they apply, whether it's how they perform their research, whether they use analysts or not, whether they collect data in an automated fashion. Also, what kind of indicators they're using. These ESG ratings are often built up with different levels of granularity. So there is much differences in terms of what data points are being used, and of course, what kind of weights are being used for to get to these so-called ratings. Also, we see big difference in terms of the coverage across data providers, whether it's the geographical coverage, coverage in terms of asset classes, but also coverage across the amount of companies that they're dealing with. We're seeing a lot of there is less data available in emerging markets, but also in small caps, and also private markets are still not very mature. And lastly, we also see big challenges or differences in terms of the update frequency. There is some ratings that are being updated on a yearly basis or a quarterly basis, and sometimes there is even a near real-time or real-time update in these ratings, and that's often the parties are using news data. And lastly, we also see differences in terms of the scale that they're using, which makes it very challenging to compare these ratings. For example, both Refinitiv and Sustainalytics are using a score from 0 to 100, while for Sustainalytics, that's a risk score. So that, comes with its own challenges in terms of the interpretation of these ratings. And if we look at news data itself produces a very valuable source of information, specifically when you want real-time ESG signals. There's a lot of companies in this space like True Value Labs and Ravenpack that are collecting thousands of data points or from different news sources and are performing state-of-the-art NLP and sentiment analysis in order to produce valuable insights for their users. So, for example, this would allow any investor, whether it's from an investment purpose or even from a risk management purpose, to track company level events. For example, recently where an event happened on an ESG related controversy occurred at Google, where the firing of a black executive led to some protests among employees. That often leads to an impact on the ESG rating of such a firm. Also very interesting is to look at how you can use news data for more supply chain events or supply chain analytics. So for example, when we look at news data, we can also detect how a company is linked to other companies where it's collaborating with, whether it's partners, suppliers, or even companies that it's selling products to, and that also produces a very valuable form of insights. So, for example, suppose that Apple is doing business with a company that is involved in any human rights related controversies. As an investor, you want to be aware of that, and you want to be able to track that. The potential downfall of this, of course, is also related to not only the source of data that you're using, but also the types of insights that you're generating or providing as a result of this. And a very good example is the Boeing 737 crash that happened in Ethiopia a couple of years ago. And there was one specific ESG data provider that was using all the news articles as a result of that event related to Boeing, but also tracking them and linking them to Ethiopia, and that negatively impacted their ESG score and also their emerging market bond index performance, and as a result of that. And then lastly, of course, it's very interesting to also explore, how are we going to overcome some of these challenges. And with the presentation we're going to give around the ESG booster, we will going to showcase how we are tackling some of these challenges. Of course, the short answer to this, there is no one single answer, meaning that a lot of it has to do with understanding the underlying data and all the underlying differences. But one good example that we've done ourselves is shown on the screen, where we're trying to look at so-called self-reported data and comparing that with news data. And how we do that is by gathering the so-called sustainability report from a set of companies and extracting the ESG initiatives by using the SASB taxonomy. And by using, on the left, the so-called seaborne visualization, we're able to not only detect how well a company on itself is doing from an ESG point of view on the specific matters, for example, diversity and inclusion, but we're able to benchmark it against their industry peers and maybe even look back historically how that has evolved over time. And that allows us to see how well such a company is performing against its industry peers. And where it becomes even more interesting when we compare those insights against the news data, because from that perspective, we can not only compare the communicated ESG initiatives, but also how the company is being perceived in the market by looking at news, by using the same taxonomy. So that's one of the examples that we're using to overcome some of these challenges by only looking at a single source of data. That brings me to my short key takeaways for my part. I think as the ESG data landscape is still evolving and regulation is evolving, we do think that there is a strong necessity to move away from these so-called subjective ESG views and to move more towards data-driven insights. And how can companies do that? Well, we're seeing a lot of the more mature parties in this space diversifying their data collection approach or data sourcing approach by using data from multiple data providers and combining it with their self-reported data or their own data sets. And there is where we believe that you can get a much more holistic or complete view by combining the so-called inside out and outside in view from a company. Also very important is to understand the underlying data quality. So understanding really how understanding the data behind the data and also the granularity, and that can be done in multiple ways. For example, by engaging directly with the companies and understanding the different metrics that they report on, but really focus or understanding the different methodologies that these data providers are applying. And lastly, I think, as it goes without saying, that's what we're going to showcase to our demo today, that a lot of this also has to do with investing in strong data sourcing, data automation, data management, data governance, analytics, and data science capabilities, because that is what we believe is really will allow companies to sort of grasp all of these these big data sets and to produce meaningful insights. So that brings me to the end of my part of my presentation. I'm going to give the word to my colleague Rajul, who's going to showcase the ESG booster and also showcase how we're handling some of these challenges.
Thank you, Hashim. Thanks for the informative session. Also, looking at the time that we have at hand, I think we have been busy with the ESG booster for almost more than 12 months now. This is one of the initiatives that we have undertaken. And without any further ado, I will directly move to the demo of ESG Booster. Yeah.
Welcome, everybody, to the demo of ESG Booster. Let me start by saying that we have not built it as a final product, but to showcase the art of possible and give inspiration to our clients in terms of what all can you do with ESG data. So what you see is the landing page of the ESG Booster, and you can upload any given portfolio either through an API or through a CSV file. And we are also extending this functionality to be able to integrate that with the leading portfolio management systems. So for today, I'll use a diversified portfolio, which consists of 25 companies. We go to the home page of the ESG Booster, and what you see is the portfolio level ESG score for these 25 companies. The aggregated score is 60.06. It also shows comparison how the portfolio level ESG score has evolved over the last 1 year. Then a functionality that can come handy for private banking clients or wealth managers or any other where the reporting is required is to compare ESG with leading benchmarks and indexes. This is configurable. So you can add a new index or benchmark and look at the given portfolio and how it fares against the other leading benchmarks in terms of E, S, and G. Then you see how the portfolio score has shaped up over the years. One key functionality here is the portfolio outlier functionality, and what my colleague Hashim also highlighted, that there is a lack of consistency and convergence when it comes to the methodology and scoring by different data providers. So in this case, the two leading data providers are not able to agree about the score of the companies within the portfolio. So if the 4 companies shown in red have quite a diverse score, even after normalizing. So our data science team did a normalization. And what you see in case of a bot, that especially for governance, it has a very high outlier score. And this can become a candidate of interest for the analyst to further investigate and see where this is coming from. You can also see news filtered on ESG for the companies within the portfolio at the bottom of the page. Our ambition has been to keep the ESG Booster data provider agnostic. So it does work with currently the leading data providers, and we are extending slowly this universe to include all the major data providers that are out there. Now I would like to move to the company level detail or company level ESG data. So what you see on the right hand side is various companies within the portfolio. So when we click on Qualcomm, it takes us to the Qualcomm specific page for ESG information. What you see here is Qualcomm has a quite a low ESG score, 34.71. It has also come down compared to the last year. We have included something called the forecasting functionalities, because one of the other key challenges with ESG data is that it only gets updated once in a year or maximum twice in a year. So the view on ESG for a given equity is quite lagging. So based on the historical movement of that given company in terms of ESG, and also taking into account the new sentiment, we have come up with a forecasting functionality. What you see at the bottom of the page, and I think that is very relevant for today's webinar, is that we have tried to capture the spectrum of ESG. So it's starting with the traditional data provider, which we call the historical performance. So you can see how the score has evolved. And then we move on to something called the new sentiment, for which we have partnered with Raven Pack, a news aggregator. And what this would do is filter the news for Qualcomm based on ESG parameters and give you the new sentiment. So that is, more real time and gives a view how the market is looking at Qualcomm in terms of different ESG parameters. And then from traditional data provider to news sentiment aggregators in terms of ESG, we move to the community view. That will also be captured later on by Tanya in the webinar. And when I click on ESG positioning tab, this is what we see. And what we have done is we have tried to integrate Orenda data into the ESG booster to make the view as complete as possible. So currently for, say, the last 3 months data. And the key highlight here is that we get Orenda data every 10 minutes. So it's almost near real time. And you can add, social parameters in terms of the score. It looks at the sector average. It gives you the breakdown of E, S, and G as well. So by doing that, the complete spectrum of ESG has been covered as far as the ESG booster is concerned. And then we also included some other key relevant data in terms of emission that might be handy for either reporting purposes or looking at, different modeling data that we need. We talked about the outlier functionalities earlier on the home page, where we looked at 2 different data providers. We further extend that not only to the companies within the portfolio, but the companies within the investable universe. And what we are also doing is building another key functionality called the network analysis, which will look at the supply chain and not only Qualcomm, but suppliers, irrespective of where they're based. Finally, what I would like to capture in the demo is one of the key functionalities, what we call simulation. So you have a given portfolio, which has also been showcased on this bubble chart. So every company in green has a positive influence, and size of the bubble showcases here the shareholding in the given portfolio. And every company shown in red has a negative influence on the portfolio level ESG score. And as an asset manager or a buy-side firm, what you might want to do is just look for alternatives. And we run the simulation. So we have partnered with a Belgian fintech company called InvestSuite, combining our ESG algorithms with the portfolio optimization, algorithm. And these are the 2 alternatives that are suggested. So if we look at the starting portfolio and then the simulated portfolio, we try to keep as close to the starting portfolio as possible in terms of the region allocation and the currency breakdown, but still improving the ESG score. And then to give confidence that we just not picking companies with a better ESG score, but also looking at the financial value. You see the portfolio value over the last 5 years shown in green if we would have chosen the alternatives, and the starting portfolio shown in blue. So that gives confidence, to whoever is running the simulation, that you can not only improve the ESG score, but at the same time, you can also, keep at least the financial performance intact. So this in a nutshell is some of the key functionalities of the ESG booster. And now we go back to the webinar and take it further from there. Thanks for joining the demo. Thank you.
So with the ESG Booster demo, we were able to showcase the power of possible. And also this can be used in different shapes and form by different clients, either as a white label solution for inspiration purposes or in a sandbox setting. And we can showcase this in a much detailed setting, as the set of functionality and what is covered is quite extensive, and this area is evolving as we speak. With this, I'll come to the end of the demo and the ESG booster. What I would like to draw attention for the participants is a question that we have in the tab, Slido tab, what you see on the screen. And the question talks about what would be most helpful in advancing ESG data for you. And different options that are out there are either training, workshops, more quality data, or comprehensive ESG strategy, or you don't know about that. So if you like to take part in that questionnaire, please do so. And with this, I'll hand over to Tanya to take us through the community view when it comes to ESG data. Thank you.
Hi everyone, and hi from everyone at Arenda. We are headquartered in Canada, and in March became a part of SIX, which is headquartered in Switzerland. And joining them is one of the best decisions I made as CEO. They are a wonderful company, and we feel quite at home. So I have a few minutes to speak with you today, and I appreciate that I follow some deep data dives. The sample data shown on the platform is the most basic use of our data, a good way to get started if you're getting familiar using alternative data in ESG. One of the differences you will see between Arenda and other ESG data providers is that we are real-time and heavy data delivery. It's not just for the asset manager who just wants to know once a year how a company is performing when it comes to ESG. It's for the investor and asset manager who wants to stay on top of a company's ESG performance every single day. In order to get that heavy level of detail, we work with social media. So why social media? Just looking for my slides to move forward, I think. So we rely mostly on Twitter because this is where society gets their news. And unlike what many critics may think, the discussions are real. Users are sharing content and discussing critical and often difficult and important topics such as COVID-19 and Black Lives Matter, which were among some of the most heavily discussed topics of 2020. Also, Twitter added features for fact-checking in direct response to the US election and conversation control to help create more valuable and positive discussions. They suspended close to 1 million accounts in the first half of 2020 due to hateful conduct. This is also working to quickly suppress the spread of fake news at the source. So a common question that we get posed to Arenda is about fake news and social media. So I would like you to think about this. There are on average about 500 million tweets per day. There are premium agencies headquartered around the world using Twitter for data mining. One of the largest foreign intelligence agencies in the world, the CIA, reads about 5 million tweets a day. Its job is the same as ours, to derive intelligence from seemingly innocuous data. They know Twitter is a goldmine, and so do we. So social media allows us, as well as the CIA, to uncover what we classify as contingent truths true as it happens, to help make decisions in real time. Perfect. That was the slide. You can go back. Once it's deemed fake, we move on. Until then, it's treated as true. So our technology is automated, uses if you can go back one more slide, uses real-time aggregation, organization, and analysis for large amounts of data. We find patterns that are invisible to humans, and we are creating new categories all of the time. So although it was a standalone data in the platform that you just saw, we often package these insights with traditional data, including pricing data, corporate action data, because it's at a similar frequency as in data delivery. With Arenda, a new ESG score, as we said, is available every 10 minutes. So some more stats about social media. News from around the world dominates the platform and moves quickly. The majority of these users, about 73%, follow professional journalists. Also, journalists use it often for research and reporting for their own news sourcing. In fact, the heaviest users of Twitter are actually the media from around the world. It's also strong in political conversations, as you would see over the last couple of months, with 83% of the world's leaders on Twitter and directly engaged in important and critical topics impacting their communities and constituents. Again, this is the platform for important, difficult, and critical conversations. This includes conversations about the environment, social rights and wrongs, and governance issues. So while some ESG companies look at a few hundred data points a year for each company they analyze, we pull in thousands of data points every day about each and every company in our universe. Is quite intense. We see first when a company is being called out for using modern day slavery as an example in their factories. It's also, and there's so much more available. It's also where companies are being outed the fastest for greenwashing, gender washing, and woke washing. So let's keep that in mind as we go on to the next slide. At Arenda, we decided that we didn't want to rely or wait for a company to report on its ESG activities. So we stepped outside of the traditional reporting and connected our smart technology directly to the social media fire hose. So we had a few priorities when we developed Arenda. One was that when a company behaved well, we wanted to measure reactions from the community in a quantitative way so that we could quickly understand how that company was performing at any point in time. So when reaction to corporate behavior was favorable on social media, we want scores for Arenda's metrics to rise. And for the opposite to happen, scores would go down if our reactions were unfavorable. So this is an important feature because it allows us to take conversations about a company, such as Rio Tinto, which you see on the slide, organize them into any metric we value and score it. So after, over the years and after a tremendous amount of research, we were able to prove that these external conversations were just as important and just as dynamic as a company's stock price. So if we can go on to the next slide. So how do you use all this beautiful data from social media to help support decisions? So when you get comfortable with using our data, the options are truly endless. We constantly get to prove that alternative data is key to gaining alpha, but we've had years of working with Arenda's data, and we've been able to benefit from a lot of peer reviews, back testing our assumptions. So this is our newest use case. A customer asked us a few weeks ago to rate the pharma companies based solely on Arenda's ESG scores, and then compare it to the ratings of one of the biggest traditional ESG rating providers. So as you can see on the left, the traditional provider rated Moderna much differently than we rated Moderna, which is on the right in gray. So the traditional ESG rating company gave Moderna a high risk score, as you can see on the bottom left, and the rest of the companies a medium risk rating. So our data, which you can see on the right chart, had Moderna as the highest scoring ESG company in the public's eyes, followed by the others. In fact, our data show that the community believes that Moderna is the best ESG performing company since 2019. So if we go on to the next slide, we can see what this all means. So we aren't here to say that one methodology is better than the other, that it's an endless debate. However, we would always side with the community's choice when it comes to investing our money. So as an example in this chart, we invested $1 beginning in December 2019, and you can see how that looks over time. We also looked at it from the traditional ESG providers' choice. And we were able to show that over 18 months, this would be their results in gray. So for the industry trading strategy shown in red, we invested equally for all 18 months. So we do know that social media is a gold mine. I thank you very much for this quick introduction into ESG at Aranda and performance data. And now I hand it back to both Jorn and Raju.
Yeah, and thank you very much, all other speakers, of course. What we try to organize and what we try to do in this webinar is to give you a flavor of the ESG spectrum. And we started off with the regulatory side of the ESG spectrum. Then in the middle, we have the rating side. And in the far end, we are looking at the ESG alpha generating and the sentiment side of ESG. Rajul, do you think, looking at the time, that we can go for some questions, or
I think we have received a lot of questions, and our ambition would be to respond back, if not live, definitely by email, depending on to whom the question was targeted. But we definitely have time for one question, and that is for Janine. Janine, if you would be kind to answer how to obtain ESG data on corporates when CSRD is not yet in force and no data is disclosed.
Okay, thank you, Rahul, for that question, and to whoever submitted it. So that's indeed a good question. And, you know, it's not that no data is disclosed. Of course, nowadays, companies do already make disclosures, and there are providers that collect this data and, you know, make use of it. But it's true that, you know, the exact SFDR standard, if you wish, the principal adverse impact indicators that have been defined, that there is only little data that actually really confirms to those standards. So what we see from the providers is that they come up with proxies. So they kind of, you know, may fill a data point, but not with exactly what the regulation requires. But again, this will develop over time. So we indicate to our clients if it's an exact match or if it's not according to the regulation. So if it is a proxy, and, you know, over time, I think there will also be pressure from the financial institutions on the corporates to make more disclosures so that they can actually make the disclosures they need to do to their clients and the public. So a very interesting space, and we see a lot of developments on this in the coming months and even years.
So, thank you, Janine. Taria, by any chance, do we have the result of the survey that you would want to highlight? So, in the meanwhile, I'll again, till we draw up the results, thank everybody for joining. And as Jon said, the ambition was to cover the complete spectrum of ESG data, starting with what SIX is doing in terms of supporting on the regulatory data side, then looking at the traditional ESG data space, moving on to, you know, niche players in terms of either looking at ESG data from a news lens or the community view. So that was the ambition. Jon, to add, or Tanya, do we have the results by any chance?
No, thank you for this. I noticed that there were a lot of questions, and I'm going to respond to them in written, if that's okay with everyone. Hopefully I have the ability to do that technology-wise. So thank you for everyone, and it's a real pleasure to meet you.
Yes, thank you, everybody. I can't get my hands on the poll answers, so unfortunately I cannot share the end result here. I want to thank everybody for their time. Seeing it's nearly 2 o'clock, and probably another interesting team meeting is awaiting you all. And otherwise, for people who have lunch, enjoy your coffee, or it's time for the closing of the day. So thank you, everybody, for joining. And feel free to reach out to us. You've got our email addresses, telephone numbers, and we're more than happy to discuss this spectrum or parts of the spectrum. Rajul, anything to add?
No, I think thanks one and all, and have a good day. Thank you.